All right, so who here remembers December 18th of 2024, this gigantic red day? I happened to not be able to trade it that day because I was part of the closing bell ceremony for the Nasdaq exchange on that specific day. Why am I talking about that big red day? Well, because I all of a sudden just saw some very interesting similarities between what's going on now with price action and what happened leading into December 18th. But not only from just a price action perspective and, hey, it looked like this there for the price, whatever. I'm seeing it in terms of gamma. I'm seeing it in terms of back month versus front month volatility and some very interesting levels that we're hitting just overhead as the market today pressed into new all-time high territory. So in today's Stock Market Brief Show, I'm going to break that down for you. Overall, I just want to be very clear here. The trend is bullish. New all-time highs, it's not a bearish thing. However, I do want to call out that if you're starting new positions at these levels, you may be in for some consolidation and or pullbacks in the very near future. I'd also like to remind people that people really did freak out on the day that we saw right here on August, going into, I think that was August 1st, that big down day. People were saying, goodbye bull market, it's the end. And I clearly stated out here on X that people were saying this, and I doubt that that marked the all-time high top on the S&P 500. Let's get into today's episode. All right, welcome back. Hey, so really quick, sorry, I have a PSA, public service announcement. I know a lot of you are in this Discord already, the $9 a month of swing trading. I have to update what's included in this because I've added like my Asherbot, which gives you like the daily implied moves, a bunch of different things where you can type in various commands here with tradie ticks, get all that stuff. This is the Asherbot, kind of what it looks like. And I have some upgrades going through it. You get premium discounts, all this kind of cool stuff, watch list, etc. The reason why I wanted to just make a PSA on it right now is because if you want to be a part of the community for $9 a month or even less, if you sign up for the entire year, get yourself grandfathered in now, because the cost of running it are now getting a little bit out of hand now that I'm doing development work with my Asherbot and having to pay for the API at an enterprise level. It's getting like pricey, like really pricey. So I'm going to have to increase prices. Now, it's still going to be very affordable, trust me, but it's like really, really affordable for all the data and all the stuff that I bring to you right now. Okay. We're going to go ahead and just really quickly zoom of what's been going on, right? Consumer prices, they did rise to 2.7. However, that was less than expected. We kind of discussed that on the prior episode. Now, what's going to be on the next report here in September, right? Are we going to get an increase in inflation? Well, what took place as far as the meeting probabilities go for rate cuts? You can see that they are pretty much locking in a 25 basis point cut there in September. In October, that increased, right? That was more of a coin flip. Now we're looking at about 65.9% of a probability of another 25 basis point cut. And looking out to December, that's around a coin flip, a little bit higher than that, another 25 basis point cut. So the market right now is pricing in 3 rate cuts to the end of this specific year. And how is the market responding overall? Well, you can see we had this scary day that everyone freaked out about, right? That's what happens in low vol environments. You get vol that's crushing, small little up days. And when vol increases, bam, it freaks everyone out. And then you go trickle, boom, to all-time highs once again. Small caps, look at small caps. These things absolutely exploded on the back of the news, right? The probabilities of cutting rates. So small caps took off today and the prior trading session being the bigger winner. I do want to call out that they are now running into their upper monthly implied move for the month of August. We're not too far off the quarterly implied move. Okay, there could be more gas in the tank, but I just wanted to call out we are running into what the market priced in already for the month of August for these specifically small caps. If we take a look at the 11 sectors that make up the S&P 500 today, we can see that materials and healthcare led the way. I think there's some news around some healthcare names, and we got a big bid there in UNH and some other names there, including if you looked at the biotech space, which we talked about on the prior video, that we could potentially see those start to move. And well, guess what? We saw those start to move as well. Utilities, everything was in the green today other than consumer staples. And interestingly enough, technology closed more towards the low of the day, but it started strong. strong. Utilities started kind of weak, but closed at the high of the trading session. So I still think that utilities could be an interesting play here because they are rate sensitive. And if we're moving into an environment where we're going to get this curve steepener and potentially yields are going to come off and bond proxies are going to start moving higher, I still think utilities has the opportunity to see some gas in their tank in the near future. If we take a look at the dollar is really in no man's land right now, but a falling dollar has been good historically for risk on assets that we've been seeing, and that is the current case as it stands right now. The 10-year yield started off pretty strong on the news of CPI, which was kind of interesting to me when I was looking at oil. So that to me was a little off because I was thinking yields could come off, bonds go up. That wasn't the case on the day of CPI. However, today you can see what happened. We fell 1.28%, breaking a little bit lower there on the 10-year yield, pushing bond proxies up. And if you take a look at oil and the 10-year yield combined, right? The black line is oil. The candlestick chart is the 10-year yield. This one really didn't go anywhere, right? It's been going straight down. And this one there, shortly there, followed that kind of path. You can see oil can be a leading indication of where bonds are going to go or yields are going to potentially go. Now, oil has been coming off pretty hard and fast here. So another thing to kind of think about as we move into the next CPI report, what happens here if oil starts to bounce, right? If it starts to rise, because it's one of the bigger contributors to obviously inflation. Well, that could potentially help produce potentially higher print there into the future. So we'll watch to see how that plays out. Overall, though, it's been coming off and breaking and still in a bearish trend, I would say. Now, if we look at the big picture of what's going on with the yield curve, this is the 10-year 3-month. It's pretty much flat, right? We're at 4 basis points. So it's not really going anywhere. There's been a lot of people talking about the curve steepening, and what they're talking about there is not the 10-year 3-month necessarily. It's the 10-year 2-year, which has been steepening. And the reason why I share this chart now is because we are now getting close to cutting rates. And when we cut rates, this could potentially fire off and steepen. And the last times we saw this was at new all-time highs, and the market went, we ran into some volatility. Is that going to be the same type of outcome? I can't tell you that specifically, but what I can point out is throughout history, that has been the problem. And what you will notice here, as we hit new all-time highs, as we started cutting rates and we started to uninvert, we did fall 23% in a matter of moments on the S&P 500. And back then, when that was taking place, we looked over here and said, well, guess what? In the 90s, we did the same thing, right? We saw a 23% decline before obviously heading higher in the markets. Now, if you take a look at the 10-year, 2-year yield curve, that you can see has been steepening, and you can see we're right at about, 56 basis points. So I just thought, hey, let's see where we were as far as rates the prior times we were there and over here as well. And you can see COVID would be the exception. This is where we kind of had this kind of crash, but rates were already at 0, and that the yield curve was steepening up into around this range. But you can see going into the financial crisis, the curve was steepening here too as well before we really kicked off the full rate cut cycle, and then things started obviously breaking. You go back a little bit further, into the 90s, the dot-com bubble, we were not, like crazy far off the all-time highs. This was a pretty big decline to where we stayed as far as where the yield curve was and how we started cutting rates. But keep in mind, that still opened the door to more significant rate cuts, a steepening yield curve, and the markets deflated at that specific time. So I would still say that this, you want to pay attention because the momentum is still to the upside here. But what are we preparing for here going into 2026, right? We still got a lot of time here. So things could be good on the shorter horizon, but we can't forget the backdrop of what has happened in the past and what has the potential to happen moving forward. If we take a look at the S&P 500 on the daily time frame and use the 5, 10, 20 timer, this is just pulling the EMAs 5, 10, and 20. You got the 5 stacked above the red, which is the 10, and stacked above the green, which is the 20. They're all stacked up, floating up. So this is actually a bullish trend. And you can see we actually started all flipping positive over here, and it's been holding that stack kind of moving average since that point. We got a little bit of a confluence kind of coming together here, but yet still remained in a positive trend. It's when it starts crossing all under that you want to obviously be a little bit more cautious, because the trend could just tell you from a lagging perspective and a moving average perspective that it is shifting from the shorter time frame. If we take a look at the put to call ratio, we did get a pretty big spike down here, which is bullish, right? However, if you look at the 10-day moving average of it, we're floating at 0.88, I believe it is right there. Yeah, 0.88. on the 10-day moving average of the put to call ratio. And that's not extreme above 1.0 where things are overly bearish like they were down here when we talked about it, right? And then things weren't overly bullish like they are down here when they starts to get below 0.8, which led to this sell-off. And the last time we were down here, we called that out and we said, hey, when it crosses back above, just know that this is where pullbacks have happened and periods of consolidations. And what happened? Well, we got down there. The market sell off, we started climbing back up, we started push back, and then we started going. So this right here was just legitimately a month or so of trading basically within a tight range before exploding from it and then kind of creating another range. So we're not extended at any specific level here looking at a put to call ratio perspective from my perspective. And if you include, this is the put to call ratio here, if you include skew to that skew, you can see people are hedging. It is historically high level here, but from the shorter perspective, we've been at these levels for quite some time. So I will talk more about this if we start to get a little bit more frothy readings. For example, remember over here, this is skew at basically all-time highs while the put to call ratio was at these lows. And that right there is telling you, hey, things are very bullish, right? From a put to call ratio, like overly bullish. That's where you want to fade them. And then over here, you had people hedging, right? Like crazy, right? This is skew at all-time highs. And then what did it lead to? Well, it led to a big market sell-off, okay? So we'll continue to watch that too. Now, this is where the original thumbnail came into play and where I want to look a little bit more behind the curtain of how, the similarities that I'm seeing here that can lead to another kind of freak out type of moment. And that is one thing here is looking at back month versus front month volatility. We are now getting a reading of 1.26. So what that tells us is that back month volatility, 3-month volatility is 26% higher than front month volatility. And if you just look throughout history, when we've gotten to these extended levels, what has happened in the past? So the last time we were there was December, right? Beginning December, and it went up pretty high. It can go higher than this, the little markings here. What happened? Well, we started running into December 18th. Right? Where we saw that break, went higher, went lower, went to new all-time highs before coming back down. Created a lot of volatility in the markets. The last time we were actually at an extended reading was just over here. And guess what happened? Well, we saw a little bit of a break in the market just recently. And if you've been watching the show, we talked about that when it was actually occurring. The last time we were at these higher levels, you can see a bunch of times throughout over here in 2023. And that led to a lot of consolidation here before breaking higher. And then we went to more consolidation before going through a 10% correction there in the S&P 500. Okay, so that's one thing. Back month for front month volatility is getting to a level that's telling us, hey, if you're looking to execute new positions here, you might want to just pause and see what happens as far as consolidations take place. Or, if you're looking at individual stocks, make sure that the setups are there and the risk to reward is there to really make sense. Because if the S&P 500 comes in, right, you can have rotations take place. And that's where you can see big moves in names that have been kind of quiet. However, if things start to correlate to a high degree, like a 90% correlation, that's like a more of a capitulatory type of move where you see like everything kind of come in. Now, the reason also that I want to kind of point out, like, hey, this is getting a little frothy over here. If you take a look at net gamma, we're roughly at 6,500 as it stands right now. We're slightly below that. And on the last episode, we talked about, hey, if we can get through 6,400, that's bullish for basically a shot up to the upper weekly, the JPM Collar, and around 6,500. So that level is a big pin. So if we come up here and go exceed it, I wouldn't be too surprised to reject from it or ping around that 6,500 until we see proof that traders are reaching out further. And that's just not the case in this exact moment on this specific chart, but that always changes. Another interesting thing here today is we ran into the upper weekly expected move, basically to a T on the SPX and the JPM Collar short calls, which is the upper bound of the JPM Collar. If you don't know about the JPM Collar, just do a quick Google search. Now, I want to also be clear, the 6480 was their original implementation. This is what I saw hit on the options chain, a massive order. They do adjustments, right? So that when they ran their adjustment, they press it a little bit higher. I really don't care about adjusting it 25 points higher, which basically puts us at the call wall, right? A big deal. I don't necessarily trade off JPM Collars. It's more of just, hey, we're reaching up to these levels. This is where things could kind of get rejected or pin or ping pong around. It's more of the happy place. But I do want to say, like, we hit that. We were just 20 cents above it on a $6,000 product and it rejected and came back up. So pretty impressive stuff overall. I will note that also the prior quarter, a JPM, when they were putting out their collar, it was a cluster. They messed up just gigantically. They put it out and then it was just change, adjusted. But overall, I keep the initial order on there because when you have an order the size that they press and the magnitude, well, computers see it, algorithms kick off, and there's a lot of price memory with that. And you can see today we reached into it, we kind of came in a little bit, and that also was in confluence with the upper weekly move. So right in and around this area is what I'm kind of calling out, that we can see that overhead kind of resistance is 65.10 to down to, 64.78, which is the upper weekly implied move for the SPX. So what does this mean? It means that the reward to the upside in the short term is being minimalized while the reward to the downside or risk, right, is increasing. Okay, so another interesting thing that I want to call out here too is this specific chart, right? So this chart is highlighting the times that we fell under the gamma flip line, which we're currently above. So dealers are going to look to buy the dip, sell the rip, okay? We're above the gamma flip line, and that's where volatility typically, right, comes in. And then when I show this chart, this is highlighting the times that we fell under the gamma flip line. So for one day over here, we've slipped under the gamma flip line, volatility shot off, and then all of a sudden we get back above it, and what happens? Volatility sinks in dramatically. You can actually see that right here. This was August 1st. Boom, August 1st, we went into negative gamma territory. We were there for one day, and then we went back to a positive, back above the flip line, and we saw gamma start to increase, and that is what brought volatility down. Now, another interesting thing that I found out here was why I'm kind of talking about, just be careful in these levels, is because not only back month, first front month volatility getting extended, not only because we're near the call wall, the weekly implied move, the JPM collar, etc., and volatility is basically coming into a new year-to-date low, but if you look at gamma, right? If you look at net gamma, we're actually approaching an area that we haven't seen since December of this last year, and happens to be December 5th. So I like to look at that and say, hey, what happened December 5th? Well, right over here, we started breaking out higher, and then we went through a period of consolidation before a massive breakdown, and we saw increases of volatility. So we're in an area where it's very likely to start consolidating and or pulling back. But also what I just found from an analog perspective that I found so interesting about this, you have to kind of zoom in and look at them side to side. But if you look here, you had this red candle, boom, bigger candle, right? Red candle, boom, bigger candle. And then you had this massive break, right? Of volatility kind of exploding. And it just so happened to be that break, right? If you were looking at it, like I said, volatility back month for front month was getting frothy. So it was to be expected, okay? And then you get this rip back, right? People freak out, and then you get this massive rip back. So you get the massive break, you get a massive rip back, and guess what? December 5th was this day over here, right? Bam, what did we do? Oh, we consolidated, and then we broke. Well, where are we now? We're up here near all those extremes. What do you think's going to happen? Well, yeah, of course we can go up higher. That's totally fine. But if it comes back in and consolidates, you should not be shocked, taking a little bit of a breather. Now, if we're going to have this type of break, I don't know about all of that, but that is why I'm pointing this out, is because if you have the opportunity to update stop losses, take partial profits, look at some of the names that maybe haven't been performing that you may get rotations into in the very near future if the bigger markets, right, the S&P 500, the large market cap stocks, want to stall out, take a little bit of a break, cool down before this path has the potential to continue. Hope today's episode helped out. I'll see you on the next.